Swayam Prabha. Digital India. Educated India.
Hello friends, I welcome you back to the series of our lectures on Fintech. In today's lecture, we will be talking about evolution of Fintech. We've already understood in the previous lecture that what is Fintech, how it is different from traditional banking. Today, we will be understanding that how Fintech has evolved or how technology in the financial services has evolved in its present scenario. I am Dr. Aparna Samudra. I am from Nagpur University and I will be taking you through this journey. Let me start with this image in front of you. You see a man going to an ATM and withdrawing money. I'm also showing you a picture of the various payment apps like Paytm, GPay or PhonePe. There's also a picture of a robo-advisor wherein there is asking you that what do you want to do? Do you want to invest? Do you want to have personal loans? Do you want to buy a credit card and other financial services? Now, what do you think? Has this always been this case? Or is it a recent development? Has it always been like this? Or is it something very new? So, to make you understand this, we are here to trace the evolution of Fintech, understand the players in Fintech, and understand the benefits and challenges of Fintech. As I put you a question as a reflection spot, do you think ATMs, UPI, and robo-advisors or similar form of use of technology in Fintech, is it something very recent or it has been there for quite some time? That answer we will get when we see the history of Fintech. Many of you might be surprised to note that the history of Fintech can be traced back to 19th century, with technology being used in finance for over 150 years. Something which we think has come recently, but it has its roots or it has evolved through 150 years in its present form. The birth and rise of Fintech, however, even though use of technology in finance has been in use for last over 150 years, but the birth and rise of Fintech, particularly Fintech if we say, in its true form, is deeply rooted in the financial crisis of 2008, which we also called as the subprime crisis, which led to the erosion of trust amongst the general public. When big financial institutions failed, people lost faith in the formal financial or traditional financial system. And that is where we see the root of the Fintech that we see in the present form. This can also be seen by this figure. This is a graph which I have taken from Google Trends, wherein we see that since when Fintech as a term has seen the growth. So if we see this, if we trace it from 2005 to 2024, if you see the rise of this term has been more so after a period of 2016. It went up very high after the COVID pandemic. So, Fintech per se is relatively a new phenomena, but the use of technology for the purpose of giving financial services has been there since 19th century. So, the researchers divide evolution of finance in 4 eras. Fintech 1.0, Fintech 2.0, Fintech 3.0, and Fintech 3.5. Fintech 1.0 was the era of early innovations which lasted from 1886 to 1967. Fintech 2.0 was the era of the rise of computers in finance, which stayed from 1967 to 2008. After the subprime crisis, from 2008 to 2014, we say this is the era of digital transformation, Fintech 3.0, and then Fintech 3.5 is the use of advanced technologies like AI, machine learning, computer vision, and NLP to give better personalized services to the customer. So that is the era in which we are presently in. That is Fintech 3.5. Now let us see these eras in detail one by one. The first era, 1.0, which I said is starting from 1886 and lasted till 1967. In 1860, a device called pen telegraph was developed to verify signatures by the banks. Because most of the transactions, almost every transaction was done through checks. So in order to verify the signatures made on those checks, pen telegraph was a device which was developed in 1860. However, 1866 is generally accepted the first valid use of technology in finance or fintech footprints when the transatlantic cable were set up. In 1918, another very important development in technology took place when the electronic fund transfer was done through telegraph and Morse code, and it was set by Fed wire. This era led to an era of creating network infrastructure and initiation of digitalization of money. So if you see these three main events which took place during this era, we say that it was during 1886 to 1967, if we say, even though the first fintech footprint was seen in 1866, that is when the transatlantic cable was set up, it was basically the network infrastructure. The banks were getting networked electronically, and it was baby steps towards the digitalization of money. In Fintech 2.0, Diners Club in 1950 brought the first modern charge card with simplified payments for consumers. That is, a card was introduced, as we see in the form of today credit card or a debit card. A prepaid card was introduced, which could be used at various places. And incidentally, Diners Club today in 2025 is celebrating its 75 years of establishment. You must go through the story of how this Diner Club card was introduced, how the promoter of the Diners Club card, how he forgot cash when he went out for a dinner with his friends and family. And then he realized that if I had a prepaid card, I could have used and saved the embarrassment. So that story, learners, you must go through. In 1958, American Express launched the first credit card. And in 1960, a very important event happened. Scantling Electronics, Qtron, replaced stock market ticker tape by a screen that delivered stock market quotes. Earlier, when the stock market, the share prices were to be displayed, a ticker tape was pasted. the Scatterings Electronics 1960 replaced it by a screen that delivered electronically the stock market quotes or the buy and sell price of share. So this is a picture of Quatrons, that instrument through which these quotes were showed electronically. Then in 1967, the first ATM was introduced by Barclays. In 1971, Nasdaq established the first electronic stock market. Today, for example, in India, when we see BSE and NEC, wherein computer terminals are in front of the people, in front of the brokers, and they are placing their orders of buy and sale. In 1971, it was Nasdaq which established a first electronic stock market. In 1973, an international payment system known as SWIFT was introduced, and it turned out to be a revolutionary standard for global banking. For making international payments, this turned out to be a global banking, new standard. In 1980, electronic trades and online banking systems emerged as we see them today. 1982, Trade Plus launched the first online stock trading system. And 1983, which was one more revolutionary invention which took place, the first mobile phones became available, which paved the way for e-commerce or mobile commerce that we see today. Mid-90s saw the rise of e-commerce market because mobile phones proliferation was there. The rise of e-commerce market, which relied on digital finance, made it more significant than ever because people started using their debit card and credit card for making the transactions on these e-commerce platform. In 1998, PayPal launched, pioneering what would become the norm for cashless payments. PayPal was the first one. This company was the first which introduced these payment systems in 1998. It pioneered the norm for the cashless payment. In early 2000s, banks began integrating new technology, but only as a support function for their primary channels. Still, they were not using technology as the primary channel. Primary channels remained their own traditional channels, but they started using technology or they started integrating new technology into their banking systems. And in 2008, when the crisis happened, the financial crisis happened, it sparked a re-evaluation of this whole thing, forcing the industry to innovate and adapt because people lost faith in the traditional banking system. Hence, people wanted to have a decentralized financial system. Therefore, came blockchain. Therefore, came Bitcoin and other cryptocurrencies. Now, another thing, as we have just seen in Fintech 2.0, was that banks started integrating technology into their systems, and what we also call as digital finance. Digital finance is basically the use of digital technologies like internet, mobile phones, ATMs, and banking apps to deliver financial services. Now, financial services delivered using these mobile phones and internet, used with no use of cash and traditional bank branches. So, these financial services were delivered using less cash and traditional bank branches. Digital finance hence provided access to banks and their services, for example, payment systems and credits that otherwise could hardly be reached. Now, if I wanted cash and if my branch is not available, It was a problem for me earlier. But when banks adopted this digital finance through internet, through mobile phones, through ATMs, for me it becomes easy either to go to an ATM and withdraw money from anywhere in the country, or use my mobile phones or online banking to pay the from whoever I purchased something. So it made possible for the people to use banking otherwise which could not have been used. So diagrammatically, I have given this history of digital finance. In 1950s, as we have just seen, that credit cards got introduced. People started using credit cards instead of cash. In 1960s, ATMs were launched, which we all know are 24/7 cash access machines. Also in 1960s, another important thing happened, that mainframe computing was adopted by banks for data storage. In 1970s, electronic stock trading started. And in 1981, IBM PC was invented, personal computers which replaced time-sharing terminals. Hence, banks also started adopting computers. And in 1990s, e-commerce and online trading started. That is, internet and e-commerce enabled retail investors to trade stocks online. Similarly, people could access or buy from sellers who were situated in far-off places as well. Now let's go to the next stage of Fintech, Fintech 3.0, which started from 2008. As I have already said, the 2008 financial crisis led to the requirements, among other stricter regulatory compulsions for traditional banks, and opened a new market for smaller banks and investors. What were those requirements? For example, more risk management was required. More regulatory compliances were required because people lost a lot of money. Rather, the world went into a recession after the banks collapsed. So, a lot of regulatory requirements were there. So, those requirements started in Fintech. And also 2008 crisis led to public mistrust of large financial institutions. Hence, the overall focus of the industry came down to cutting the operational costs using technology. So, 2-3 things were happening. After the 2008 crisis, banks had to incur a lot of cost because they had more regulatory compliances. More risk management tools were to be used. General public lost trust. So, in order to become more operationally efficient, the whole banking model needed a rethink, and banks also started thinking of using technology to operationalize their efficiency. 2 major events happened. One were, of course, the development of Bitcoin in 2009 as the first cryptocurrency, decentralized currency, which was not controlled by any regulatory authority. Second was P2P payment systems emerged. P2P is peer-to-peer payments. That is, such payment systems wherein no intermediary is required. As you are aware, learners, that in a traditional model, a financial institution or a bank plays the role of a financial intermediary. There is a sector which has a surplus, so they become the savers. There is a sector which is deficit, they become the borrowers. Banks have a role of intermediary, of bringing together the saver sector, surplus sector to the deficit sector. But because people lost trust in the system, a new form of payment system emerged, which is P2P, peer-to-pay payment system, where the users were sending funds directly to another user without any financial intermediary. The key differentiating factor of Fintech 3.0 was the rapid rate of technological development and the changing identity of the providers of financial services. So it was not only the traditional banking or the traditional financial institutions which were providing financial services. New forms of providing financial services, as we have just seen, bitcoins in form of cryptocurrency, P2P payments, they emerged. So a faster technological development rate along with changing identity of the providers were the key differentiating factors of Fintech 3.0. Fintech now has become, in this particular era, became diverse and rapidly growing landscape that spans into regulatory technology, RegTech, digital lending, that is making lending available through digital tools, insurance technology, which we call as InsurTech, for example, on-demand insurance, P2P insurance, digital wallets, crowdfunding and more. So Fintech 3.0 has been characterized by the rapid growth of company from too small to care to too large to ignore to finally too big to fail. And the last phase is Fintech 3.5, which is from 2014 onwards. This era saw a non-linear rise of two most populous countries, Fintech in rising in these two countries, most populous countries of the world, that is China and India. Fintech developments also started taking place in Africa, and it was considered as a growth engine from 2014 to 2018 in Africa. A very significant case study is of use of M-Pesa, mobile Pesa, in Kenya by the women there, that how M-Pesa using mobile for the payment system by the women of Kenya, how it increased their women empowerment. So I would urge you to have a look at M-Pesa case study as well. SaaS development. SaaS is software as a service. That development, like financial software by Indian IT companies, M-Pesa in Africa, payment banks in India, Alipay in China, were some of very, very significant developments which took place in 2014, and the list is still going on. So what have we understood? That Fintech 1.0, we saw the transatlantic cable. Then we saw Fedwire in USA using it. We also saw the emergence of the first credit card. Fintech 2.0, establishment of NASDAQ. Swift payment, global payment system. E-commerce. Fintech 3.0, Bitcoin, emergence of Bitcoin and P2P payments. RegTech and crowdfunding. And Fintech 3.5, growth of Fintech in China and India, and emergence of software as a service. Now, learners, these are the broad 4 Fintech players. One is the incumbent financial institutions. That is, if we talk about that, who actually is involved in this Fintech area. One is, of course, the incumbent financial institutions. That is the existing financial institutions. Second are the big technology companies which are very active in this finance space. For example, we see Amazon through Amazon Pay. We have seen Google coming up with Google Pay. We see Meta coming up with WhatsApp Pay. So those technology companies, even though they are not from the finance, their core business is technology, but they are integrating finance into their services. Then third is the companies that provide infrastructure and technology to for this Fintech, and then disruptors, generally the startups. Now, what have been the benefits of Fintech? We'll have a look at it. One is, of course, enhanced financial inclusion, because the services through financial technology, through Fintech startups, are available even to in the remotest part of the country, to the people who have lesser funds, who may not have access to the traditional means of financing. It is leading them, making finance available to them. So it is increasing financial inclusion by creating deposits, by generating loans for them, and taking them out of the clutches of the informal financial system. It also has increased efficiency and reduced cost because they are scalable systems. They do not have a lot of infrastructure overload on them for which they have to pay high rentals. Efficiency is increased because they deliver service fast through use of technology. They are also available 24/7, borderless, hence efficiency is increased. Because of fintechs today, customers are having an improved customer experience because they are getting personalized financial services available at a click of a mouse. Also, enhanced security and fraud prevention is there, particularly by the use of AI tools, by detecting whether using the past data, whether this transaction is being generally done, such a transaction is done by this particular user or not. If it sees some unusual activity, the accounts get blocked automatically. It is also leading to innovation in financial products and services. As we saw that how P2P system, payment system developed. As we move further, we will see that something unheard of like on-demand insurance is there. That is, you do not have to go by a traditional general insurance model. You can buy insurance whenever you want to, for whatever you want to, for whatever time you want to. Similarly, we talk about loans being available at a very short span of time. Digital lending is also an innovation of financial services through fintech. And of course, the use of enhanced data analytics and decision making for the businesses as well. So fintech is not only talking about the customer perspective, it is also talking about business perspective, that how businesses, particularly the traditional financial institutions, how they can use the past data to improve their services and get better products in the market and help them in decision making. However, there are a lot of challenges also by fintech in this sector. One is, of course, the cyber security threat. That is, we see that how so many times hackers get an access to the financial data, or they hack the systems of the banks. So cyber security is a very big threat. Second is data privacy concerns, because financial technology is talking about keeping your data in a digitalized forms. So data breaches happen. The data of the customers get leaked. Then another challenge is the integration with the legacy systems. Legacy systems means those softwares or those IT systems which are using old computer technology. So if the traditional banking institutions or the traditional financial institutions, they want to integrate technology into the system, they have to, this technology first has to integrate back into the legacy system, in the old system. For example, earlier COBOL language was used. Now, no one uses COBOL language for programming. But if the legacy system uses that language, it becomes important that first that old language has to be, it has to be migrated to a new technology. And then only new products and services using new technology can be delivered. So integration with legacy system still remains a challenge. Another challenge is skill gap and workforce transformation. That is, still a lot of skills is not available to work in the fintech sector. Therefore, for the younger population, this is an area where they should develop themselves on. So One is the skill gap of the new people who are going to join in this system. Another is of the people who are already into the system. To transform them, to skill them back is a challenge. And then there is, of course, a cultural resistance to change, which happens not only from the people who are providing this service, but also from the people who are using this service. So that is another challenge. So these are the challenges which the fintech sector faces. Amongst them, the most important is the cybersecurity and data privacy concern. And of course, regulatory compliance is another challenge. Now, let us revise what we have done. We have understood that the fintech evolution spans over 150 years. Fintech has been the key driver for innovation and change. So it has been the key player in driving innovation and change. We have seen that how Diners Club came, Diners card came, how American Express got into credit cards, then how we are talking about UPI, how we're talking about ATM. So it is the technology, it is the financial technology which is changing the whole landscape. And benefits, of course, include efficiency and inclusion. Inclusion of the unbanked, inclusion of the lower income strata, and efficiency by using less of, less manpower or manpower doing better things in a better way. So thank you very much. We will be understanding fintech in detail in the subsequent lectures. Thank you very much.